When you get that letter in the mail that says your annuity is maturing, it's totally normal to feel a little bit of pressure. I mean, it sounds so final. But here's the thing. It's not an ending. It's actually a starting line, a moment where you get to call the shots about your money. So in this explainer, we're going to cut through all the confusion and make your next steps crystal clear.
So you're holding that letter, and the big question just hangs in the air. Now what? Trust me, you are not alone in feeling this way. You've had this account chugging along for years, and now, suddenly, it's decision time. But the good news is, you've got choices, and we're going to walk through every single one of them together. So here's our roadmap. First, we're going to nail down what a maturity date even is. Then, we'll get into the good stuff, your 5 main options. After that, we have to talk about the important stuff, taxes and RMDs. We'll also look at a big decision, getting more income versus keeping control. And finally, we'll tie it all together so you can choose your path. Let's do this.
Okay, first things first. Before you can decide which road to take, you kind of need to know where you're standing. So, what in the world is an annuity maturity date?
The easiest way to think about it is this. It's the day your money is officially unlocked. That surrender period you had, it's over. That means you can finally get to your money without paying any of those pesky penalties to the insurance company. This is the moment the ball is in your court.
And here's some good news. You don't have to make a snap decision. Most companies will give you a little breathing room, a grace period, to figure things out. But, don't let that time just slip away. This is your chance to really dig in, look at your options, and make a really smart move.
All right, now we're at the heart of it. Let's talk about the 5 main paths you can take now that your annuity has matured. Think of this as your financial choose-your-own-adventure.
So option 1 is the simplest path. You just renew your current contract. It's a lot like when a CD at the bank matures, you can just roll it over for a new term. You're basically saying, hey, I like where my money is, let's just keep it going, with a new interest rate, of course.
The big pro here is that it's just so easy. It's a single decision and you're done. Your money stays protected, it keeps growing tax-deferred. What's not to like? Well, the one potential downside is you might be leaving money on the table. There could be better deals out there. This is really for someone who just wants to keep things simple and predictable.
Option 2 is for the savvy shopper. This is where you take your money and move it to a brand new annuity, maybe with a different company that's offering a better deal. And you can do this using a special tax rule called a 1035 exchange that lets you move all that growth completely tax-free.
This is where you can give your retirement savings a real upgrade. You could find a higher interest rate or get your hands on some newer features that just weren't around when you bought your first contract. Just remember, when you do this, you're starting a new surrender period, so it's another long-term commitment.
Okay, but what if you don't want to lock it all up again? What if you just need a chunk of that cash right now? Well, that's option 3. You can pull out just a portion of the money and let the rest of it keep on growing tax-deferred.
The obvious benefit here is quick access to your cash. But, and this is a huge but, you have to be so careful with the taxes. For non-qualified annuities, withdrawals are taxed last in, first out. That means all the interest you've earned comes out first. So if you take out $20,000 and you've earned $20,000 in interest, guess what? That whole withdrawal is taxable income. It can be a real shocker on your tax bill.
All right, moving on to something a little different. Option 4 is where you turn part of your annuity into your own personal pension, a guaranteed stream of income while you let the rest of the money keep growing.
This is how you get a reliable paycheck you can count on. And the tax situation is so much better. Instead of all your earnings coming out first, each payment is a little bit of your original principal, which is tax-free, and a little bit of interest, so it's much more tax efficient. The trade-off? This is a permanent decision. Once you flip that switch, there's no going back.
And finally, option 5. This one only applies if your current annuity already has something called an income rider, or a guaranteed lifetime withdrawal benefit. If you have one of those, now's the time you can actually turn it on and start getting that lifetime income.
Honestly, for a lot of people, this is the best of both worlds. You get a guaranteed income stream you can't outlive, but, and this is the key, you still own the account. You're in control. And whatever's left when you pass away goes to your family. It's income, but with control, and that's a game changer.
Okay, so you know your options. But before we make a move, we have to talk about the rules of the road, because making any of these choices without understanding taxes and RMDs, well, it's like driving with a blindfold on.
This is so important to get right. If your annuity is qualified,
meaning it's funded with pre-tax money, like an IRA, then every single penny you pull out is taxable, period. But if it's non-qualified, money you've already paid taxes on, then only the growth, the earnings, is taxable. And as we just saw, how you take that money out makes a huge difference.
Now, if your annuity is in an IRA, you can't just leave the money in there forever. The government wants its tax money, so they make you start taking it out at a certain age. These are called required minimum distributions, or RMDs. Here's a little warning. You can delay your very first RMD, but if you do, you'll have to take 2 in 1 year, and that could easily bump you into a higher tax bracket.
And this right here, this is the hidden trap. This catches so many people by surprise. The amount you pay for Medicare is directly tied to your income from 2 years ago. So if you take a big taxable chunk out of your annuity today, you could be looking at a much bigger Medicare bill 2 years down the road. It just shows how all these financial pieces are connected.
So if getting an income is your main goal, it all boils down to one final, really key decision. It's a classic trade-off. Do you want the biggest possible paycheck, or do you want to stay in control of your money?
Let's just look at this side by side. With a GLWB, you're in the driver's seat. It's your account. Whatever's left goes to your heirs. With annuitization, you're basically handing the keys over to the insurance company. Now, in exchange, they'll probably give you a bigger monthly check and a better tax deal. There's no right or wrong here. It's all about what you value most: control and legacy, or the highest possible payout.
Whew, we have covered a lot of ground, haven't we? We've talked about what maturity means, your 5 big options, the rules you have to follow, so let's bring it all home and figure out your next step. Look, at the end of the day, the right path forward is a totally personal decision. It all depends on what you want your money to do for you. Is it about income, growth, leaving a legacy? Now that you understand all the options, the single most important thing you can do is compare them all side by side based on your unique situation.
And you definitely don't have to figure all this out on your own. At the Annuity Expert, this is what we do. We can help you compare all your options and find the absolute best solution for your needs. Our services are completely free and there's never any pressure. So give us a call at 770-755-1565 or check us out online. We're here to help you make the right choice.